2022 was a brutal year for investors as the S&P 500 was down around 20%, but if you're a dividend investor like me looking for passive income, this can definitely lead to opportunities. In 2023, one of those opportunities will come in the form of real estate investment trusts. In this video, we're going to be reviewing the top 4 real estate investment trusts that I believe can provide major passive income in 2023. REITs tend to have higher dividend yields compared to other types of investments, which makes them more popular with investors looking for passive income. Some of the REITs we'll look at today have dividend yields as high as 10%. To analyze these stocks, we'll be using my REIT valuation spreadsheet, which you can download on my Patreon page at the link in the description. And the first real estate investment trust that we are going to be looking at is one of the most popular ones out there, and that's Realty Income Corporation, stock ticker O, currently trading at $62.91 per share. If we come down here, we can see over the past year, they're down about 12.51%, and year to date, they're down about 11.65%. So let's go ahead and jump over to our spreadsheet, and you can see we have lots of different valuation models to look at down here. Let's go ahead and jump up here on our stock screener page. We'll plug in O and hit enter, and you can see all of this data will automatically load in. Now we're currently looking at a 500-day change chart, so still you can see the price it's currently trading at is quite a bit lower than it typically trades at. If we come over here and look at the dividend data, we can see they're paying out $2.98 per share, which gives them a dividend yield of around 4.74%. The payout ratio is showing 274%, but if you know anything about real estate investment trusts, you know payout ratio is not a good way to judge the safety of the dividend. That's something we'll be looking at just a little bit later in the video. But if we come down here, we can see analysts currently have a target price of $69 per share, institutional ownership around 83%, that's pretty high, and a beta of 0.79, so you shouldn't see a whole lot of volatility with this stock. But if we jump over to our first valuation, the AFFO multiples, essentially what we're doing is we're looking at the price to AFFO multiple of these comparable companies and comparing it to where O is sitting at. So you can see the comparable companies we're using right here, they have an average price to AFFO of 17.885, while the price to AFFO for O is about 16.23, which you could argue means this company is a little bit undervalued. When you plug all those metrics into our formula, you come to an intrinsic value of about $69.50 per share, a little bit higher than that current trading price, and it's actually pretty close to what analysts currently have for their target price as well, as we can see right here. Now, typically when I do it AFFO multiples, I also want to look at the historical price to FFO for this company. So let's go ahead and do that as well. So I'll zoom out a little bit, and essentially what I'm doing is I'm plugging in the historical price per share over the past decade, plugging in the historical FFO per share so we can see that price to FFO multiple over the past decade. And what we can see right here is they had an average price to FFO over the past decade of about 19.02, but the trailing 12 months is currently sitting at about 17.33. To me, again, that's a little bit of an indicator that even though some people argue this company trades at a premium, I think it's a little bit undervalued compared to where it has traded at historically. Now let's go ahead and jump to our next valuation, the dividend discount model. And I'll go ahead and zoom in. And the first thing I do want to point out about this is we have the FFO payout ratio listed right here. This is a much better way to judge the safety of the dividend payouts for a real estate investment trust as compared to the payout ratio as we saw up here earlier. So let's go ahead and jump back over here. But essentially what this valuation model is doing is it's valuing a company based on how much they pay out in dividends and how much that dividend is increasing over time. So you can see I plugged in the monthly dividend payouts for this company so we can see how much they pay out each year. This allows us to see our dividend growth rates of about 3%, good year here at 5%, and then a relatively low dividend increase as of recently, but that's an average growth rate of about 3%. Now moving forward, I'm projecting a growth rate of around 4%. It may be slightly lower than that, but also a discount rate of 8%. But when we plug in those metrics right there, you can see we come to a dividend discount model price per share of $77.38. Now, let's say there's a growth rate of closer to 3.5%. It does bump it down a little bit to around $68.45, but I'm going to keep it at 4% now. With an FFO payout ratio of about 80.33%, I do think it's a safe dividend. So again, we come to an intrinsic value of $77.38 per share. Now, the last valuation model that I do have on this spreadsheet is net asset value. And I think this is a really important way to be able to value a company, but it's highly dependent on the variables we plug in. And this is something I talk about when I released this spreadsheet. So I'm not going to go into detail right here, but essentially I use a sensitivity analysis to see how the different cap rates and how the different net operating levels will lead to different intrinsic values. So because there's so many different variables, I'm not actually going to use this to calculate intrinsic value because I think just with so many variables, it doesn't provide a fair value. So moving forward, I won't be using that valuation model in this video. But if you want to download the spreadsheet, you can play with this yourself. But if we jump over to our output tab, we can see The two valuations we came to is around $70 per share, around $77 per share, when we come to an intrinsic value of $73.33 per share. So down here you can see you can apply whatever margin of safety you want. I applied 10% margin of safety. Based upon that, our acceptable buy price for this company is around $66 per share, meaning the company may be slightly undervalued. And I think that is reaffirmed when we look at that historical price to FFO multiple. But let's go ahead and jump over to our next company. The next REIT we're going to be looking at is a company that has way outperformed the market over the past year, and that is Vici Properties, stock ticker VICI, currently trading at $32.18 per share. We can see year to date they're up 7.45%. This is also a company that's still relatively new to the market, but there's honestly a whole lot of positive sentiment around this company. If we come over here and look at the rating summary, we can see Seeking Alpha, Authors, Wall Street, and The Quant all have this company as a buy signal, and they've been making moves in the market as well lately. We can see they're one of the biggest property owners of the Las Vegas Strip, and they recently just acquired 49.9% interest in MGM. So let's go ahead and jump into our valuation spreadsheet. We'll go ahead and plug in the stock ticker right here and hit enter, and we can see our 500-day change right here. If we come over here and look at the dividend data, we can see they're paying out $1.56 per share, which gives them a dividend yield of, again, pretty close to 5% at 4.85. Now, 20 and 50-day moving average is down slightly, but 200-day moving average still up a little bit. Analysts currently have a target price of about $37.76 per share. And look at this institutional ownership. It is extremely high. Like I said, a whole lot of positive sentiment around this company currently, and a beta of 0.95, so the volatility levels will be pretty close to that of the market. But if we go ahead and jump over to our AFFO multiples, let's go ahead and zoom in a little bit here. You can see the comparable companies we're using right here. We're typically going to use a specialized REIT to kind of value this company here, but we can see the average price to AFFO multiples around 19.76, and for VICI, it's currently sitting at 17.66. So again, looks like it may be slightly undervalued. Now, we don't have a whole lot of data since this is a relatively new REIT, so we're actually not going to be using the historical price to FFO in the scenario. But if we jump over to our dividend discount model, we can see our payouts right here and our yearly dividend payouts right here. So pretty good dividend growth as of recently, 3.5%, 10.7%, 9%, and 8.33%. That's an average growth rate of around 8%. Now, the reason I'm plugging in a growth rate of 0% right here is we can see their trailing 12 months FFO payout ratio is around 131.77%. That isn't sustainable, but if we look at 2021, their FFO payout ratio was around 74.84%. I believe, like a lot of analysts, that this FFO payout ratio is going to come back down to a sustainable level. And you can see, even with a growth rate of 0% and a discount rate percent of 8.5%, we come to a dividend discount model price per share of about $55.06. That's a really good value compared to its current trading price. The big if is, are they going to be able to get this FFO payout ratio down? I personally believe that they are. So when we jump over to our output tab, we can see with these two valuations, we do come to an intrinsic value of about $45.53 per share. So yes, I do kind of agree with the rating summary right here from Seeking Alpha. Looks like this is trading at a pretty good value. Let's say we want to apply a 20% margin of safety. Based upon that, our acceptable buy price is about $36.43 per share, meaning now is a good time to consider looking into this company. Let's go ahead and jump on to our next REIT. The next REIT we're going to be looking at has a dividend yield of over 10%, and that's Medical Properties Trust, stock ticker MPW, currently trading at $11.06 per share. Now, it's been a really tough year for them. We can see year to date, they're down about 52.86%, so that is a huge decline in their share price, obviously. Let's go ahead and jump over to our valuation spreadsheet. We'll come up here and plug in the stock ticker and hit enter. And again, this data will load in. We can see just how drastic the change in price has been over the past 500 days. If we come over here and look at the dividend data, we can see they're paying out $1.16 per share, which gives them a dividend yield of right at 10.5%. That's a really high dividend yield. Analysts currently have a target price of $15.46 per share. Institutional ownership is sitting at 84.10%, pretty high, and the beta at 0.82, so you will see a little bit less volatility than that of the market. But let's go ahead and jump into our first valuation, the price to AFFO multiples valuation. And essentially what we're doing is we're taking other healthcare REITs, as we can see right here, and we're taking their price to AFFO multiple. And we can see MPW's price to AFFO multiple is lower than every single one of these companies. They have an average of 11.62, so that does lead to a quite a bit higher intrinsic value than the current trading price for MPWs, as we can see right here. The intrinsic value is about $16.60 per share, and I think this is kind of backed up by our historical price to FFO multiple. So if you look at the trailing 12 months FFO per share, and we look at the historical price to FFO right here at 6.53. That's lower than it's been over the past decade. We can see over the last 10 years, it's averaged about 14.53. So it is trading quite a bit lower compared to where it has historically over the past decade. Now, if we jump over to our dividend discount model, let's go ahead and zoom back in just a little bit. We're plugging in the dividend payments right here so we can see how much they pay out each year. The dividend growth has been typically around 3 to 4%, as we can see, 4%, 3.8, 3.7, 3.57. So that's an average growth rate of 3.78%. So moving forward, I'm projecting a growth rate of 2%, a discount rate of 8.5%, and that gives them a dividend discount model price per share of 18.2. And even with this low growth rate, we can see this is a very safe dividend paying company. Their FFO payout ratio is only sitting at 64.93. So despite that really high dividend payout, at about 10.5%, this is a very safe dividend paying company. I think the sell-off has been a little bit drastic, as we can see that we're trading as high as around $23, $24 per share about a year ago. So when we jump over to our output tab right here, we can see we come to an intrinsic value of $17.41 per share. Let's say we apply a 20% margin of safety based upon that. Our acceptable buy price is about $13.93, meaning again, now may be a good time to consider buying this company. And the last REIT that we are going to be looking at is another company that has been hammered over the past year, and that's Stag Industrial, stock ticker STAG, currently trading at $32.10 per share. We can see over the past year, they're down about 33%, and year to date, they're down 31.7%. But let's go ahead and jump over to our valuation spreadsheet. If we jump back over to Seeking Alpha, again, we can see they have pretty strong buy ratings for this company, but let's see if we agree with them. We'll go ahead and come up here. We'll plug in the stock ticker and hit enter. And again, we're looking at a 500-day change. Let's go ahead and plug in a 700-day change right here. And again, what you'll see is there was a pretty nice climb up to this high share point right here, but it is back down to those lows, as we can see 700 days ago. If we come over here and look at the dividend data, we can see they're paying out $1.46 per share, which gives them a dividend yield of 4.54%. Analysts currently have a target price of $36.41. Again, good institutional ownership at 88.4% and a beta of 0.99. So you will see volatility levels close to the market levels. If we jump over to our AFFO multiples, one of the things you'll notice is all of these comparable companies have pretty high price to AFFO multiples when you compare it to where Stag is currently at, which is going to mean it's a little bit undervalued and push up that intrinsic value to about $49.52 per share. Now, a couple of things we do want to note on the dividend discount model as well. This is a monthly paying dividend company, so you can see each of these dividend payouts is multiplied by 12 to see how much they pay out each year, but they really do lack dividend growth. As we can see right here, we have dividend growth of 0.85, 0.84, 0.83, and 0.83. So not a single year over the past 4 or 5 years of over 1% dividend growth. Now, it is a safe dividend paying company, as we can see right here with the FFO payout ratio of about 67.24%, but that average growth rate of just 0.84 is not something I really like. I typically want to see at least 1% dividend growth from a REIT, but I'm projecting a 1% dividend growth rate moving forward, a discount rate of 8%. That only gives them a dividend discount model price per share of $21.12. So despite that pretty nice starting dividend yield, as we can see right here, that dividend growth rate projection is really going to push this valuation down a little bit below that current trading price. But let's go ahead and jump over to our output tab, and we can see our two valuations right here. When we average them together, we come to an intrinsic value of $35.32 per share, a bit higher than that current trading price. Let's say we want to apply a 10% margin of safety in this scenario. Based upon that, our acceptable buy price is $31.79, meaning it's not quite in that buy range, but it's getting very close to it. So there you go. Those are 4 REITs that I think could perform very well in 2023 if you are looking for passive income. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. You can also get a huge discount on Seeking Alpha Premium by using my link in the description. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.